All right. Hello and welcome to another Gould Asset Management webinar. I'm Scott Smith, a partner and senior portfolio manager here at Gould, and I'll be serving as the host for today's chat and Q&A with Don Gould, our president and chief investment officer. Don will be sharing some general thoughts and comments about the current state of the markets and the economy, and then we will move into a time for Q&A. We've received a few questions in advance that we will be answering, but you can also submit your questions live at any point during the webinar using Zoom's Q&A feature, which you should see at the bottom of your screen. Please be sure to post all your questions there, as we will not be using Zoom's chat feature to respond to questions. A couple things to note: we are recording today's session and we'll make it available shortly after the completion of today's call. So don't stress if you have technical difficulties or need to drop off before we finish. Lastly, we will be targeting today's webinar to last approximately 45 minutes. And in the event we don't get to answer your questions live on air, we will have a member of the Gould team follow up directly with you in the next day or two. I think that's it. So without any further ado, I'm going to turn the webinar over to Don Gould. Don, please take it away.
Thanks, Scott. And good afternoon, everyone. It's good to be back here and to be doing another one of our webinars to give you our thoughts on the economy and the markets, and just try to stay in touch with our client base. So let me start first. On behalf of everyone at Gould Asset Management, I want to send out our best wishes to each of you. One way or another, it's been a period of hardship for everyone, and we hope you're holding up well, and that you will not hesitate to reach out to us whenever we can be of help. We're about 3 months in from when the lockdown period began in earnest. It's hard to believe, but there it is, 3 months. It's also almost 3 months since the stock market reached its lowest point so far in 2020, proving once again that markets will confound you. The market high for 2020, the stock market, was reached in mid-February, and the low was in mid-March. The market's behavior this year has been so unusual that we would not be surprised to see either or even both the high and the low points surpassed before the year is out. But we'll talk more on that in a bit. So today I want to touch on two main topics before we go into a few questions and answers. The first is just a very broad brush look at the economy. And the second will be a discussion of the stock and bond markets, and in particular, the seeming disconnect between the economy and the stock market. So let's jump in and talk about the economy. I'll start with what I consider to be the good news. Nationally, we did flatten the curve, at least temporarily. Quarantines and social distancing have worked. Of course, we have read that there are some states where the number of cases is rising, others where it's dropping quite dramatically, but overall, the number of cases and deaths seem to be dropping by the week. So that's clearly good news, since COVID has been the source of this entire economic contraction. Another piece of good news is that portions of the economy that were shut down are reopening. Cautiously but steadily. The signs are everywhere. You can read about it. You can also get in your car and drive to the nearest town center and you'll see it. Activity's picking up. And today we had a very positive retail sales report, which reinforces this point. But of course, it should be stressed that the pickup we're seeing is uneven, and it's coming from a very, very low base. The very worst of the economic contraction might be behind us, provided we don't have a second and more severe spike later this year. So fingers are crossed on that, but hopefully the worst is behind us, even though we're still very much in a deep trough at the moment. The reopening that we've seen gives us some hope that whatever the course COVID takes from here, our growing understanding of COVID will permit a more nuanced policy response, a sort of optimization in which we can protect both health and economic interests at the same time. The full lockdown was a blunt instrument. It was understandable. It was arguably necessary given the state of knowledge of where we were at the time. But we're hopeful that that won't be necessary in the future, even if there is another spike. It's also worth pointing out that much of the economy continued to function very well through the last 3 months. There's the obvious parts of the economy that have been shut down, but behind the scenes, the majority of gross domestic product continued to chug along. Much of the knowledge economy has demonstrated an ability to remain productive, remarkably productive, in a virtual telework type business model, not unlike this webinar that we're having right now. And finally, work continues and fingers remain tightly crossed about vaccines and therapies. We'll know much more about that in the next few months. Okay, let's turn to the challenges or the bad news, however you want to phrase it. By most measures, this is the most severe economic downturn since World War II and the Great Depression. It's what we sort of thought it would be when we last spoke in March. Just no way to avoid it when you shut down such a big segment of the economy, that you're not going to have massive contraction in activity and a huge increase in unemployment. Many industries have been absolutely devastated. The recovery, which we remain fully confident will happen, but the recovery is going to be a long slog. If we make even the rosy and I would say unrealistic assumption that everything goes back to the way it was before COVID, just think how long it will be before airplanes, hotels, and restaurants get back to their pre-COVID levels of activity, just to pick one part of the economy. If you take a poll among your friends, I think you'll find that most are uneasy about flying still. They're uneasy about staying in hotels. They're uneasy about a lot of things that we used to simply not give any thought to previously. So this is going to take a while. Second point is that not everything is going back to the way it was before COVID. Any business that does not return to its pre-COVID levels is going to have some permanent job loss. For many, there will not be jobs to go back to. University of Chicago just last week estimated that 42% of recent layoffs will be permanent. That's at least 10 million jobs. Economists use a term for this, which they call a reallocation shock, which is that the labor force needs to be reallocated to where there was demand for labor to where there will be demand for labor. But that takes time. It takes time for people to retrain, to learn the skills that are required for the new jobs that hopefully will be available, and potentially to have to relocate to where those jobs are if they can't do it in a virtual telework format. Another problem we're seeing is that state and local governments are looking at huge budget deficits. Big shortfalls. Sales and income taxes are way down, understandably. And already 1.5 million workers have been laid off in the state and local government sector. We're hopeful that the federal government in an upcoming stimulus bill will provide aid for state and local governments. If they don't, we will see a growing shortfall in essential public services, which affects everyone, not just the people in government itself. We've talked in the past about the 40% of American households that prior to this crisis reportedly could not come up with $400 in an emergency. And these are the very same households that have borne the brunt of this economic contraction. In other words, the COVID crisis has increased economic disparities in this country. And so I think, the final challenge I want to highlight is that no matter where you sit on the economic or the political spectrum, you have to think about what getting ahead in the future can really mean when so many are being left behind. And this is something that we're going to have to tackle for everyone's economic prosperity. Okay, let me move now to the markets. The US stock market is at about the same level it was in mid-December. And it's less than 8% below its all-time high that was reached in mid-February. So think about that for a moment. In mid-December, the unemployment rate was 3.5%. Today, it's at least 15% and potentially higher depending on how you measure it. Would you have guessed that the stock market would be at the same level, given that unbelievable change in circumstances? I would not have. I don't think anyone could honestly say that unemployment could go up fivefold and the stock market would be where it was. And yet, here we are. I call it the great disconnect, or at least the seeming disconnect between the economy on the one hand, which is clearly struggling, and the stock market, which has been remarkably buoyant. I'm going to share my screen here to show you a chart to illustrate this point. The jagged blue line here is the S&P 500. So starting here at the beginning of the year in January, bumping along, hits an all-time high on February 19th, drops 34% to its low for the year, which was around March 23rd, and then has this remarkable recovery. This is through yesterday. It actually was up another 2% today, so it's up over the 3,100 level again. The all-time high was in the 3,300s, close to 3,400. Juxtapose that against this dashed line here, which is US employment, and that's listed here on the axis, the vertical axis on the right. You can see we were near 160 million people employed at the start of the year, and we're now somewhere south of 135 million employed. So about 25 million jobs lost at a minimum. Other estimates put that number at well over 30 million. And so how is it that we have this blue line climbing up while we've had this massive job destruction? All right. One second here. Well, we think there's perhaps 5 factors that could help explain why the market has held up so well. But this is guesswork. These are hypotheses. With the stock market, you can never really prove why the market is where it is. So number one, the industries that were hurt the most and have been hurt the most in this downturn tend to be industries that are lower profit margin businesses. The leading market indices like the S&P 500 that I was just showing a moment ago are market capitalization weighted. That means that the companies that have the greatest market value on the stock exchange have the greatest impact on the index. So to show how, just an example of how this works, take 2 companies, take Apple and take United Airlines. At the market peak in February, the market capitalization of Apple, that's the value of all its outstanding shares, was $1.4 trillion. United Airlines, in contrast, was $28 billion. So what that means is that Apple was about 50 times as valuable a company as United Airlines from a stock market perspective. Apple is up about 5.5%, believe it or not, since it's the all-time market high in February. United is down 60%. But the impact of Apple's 5.5% climb is an increase of its market capitalization of $87 billion, while a much, much larger change in value, a 60% decline in United, amounts to a $17 billion reduction in market capitalization. So this is an example of how really, the biggest companies, the Amazons, the Apples, the Googles, these are all companies that have fared pretty well so far in this downturn. And those are the big companies. Those are the mega cap companies with capitalizations north of $1 trillion, while it's really much smaller, lower profit margin businesses that have been hurt the most. So that might explain why the market has not been hurt as much as the economy overall. A second and very important factor is what I'll call federal intervention. The Federal Reserve created $3 trillion out of thin air. And that's what central banks do. They can create money with just mouse clicks, and used it to buy bonds. Now, why? First, it wanted to prevent a Wall Street meltdown. When credit markets seize up, Wall Street ceases to function very well. Capital markets cease to function. Money stops flowing. The Fed understandably wanted to prevent a financial sector meltdown from triggering even more of a Main Street meltdown. And the way they do this is they go and they buy bonds. They buy bonds both in the open market and they buy bonds that the government issues. And the effect of this is to drive up the price of bonds, which drives down their yields. Now, the question then is, what happened to all that money? What happened to the $3 trillion? What did the people who sold their bonds to the Federal Reserve do with that cash? And they did several things. Some of them went out and spent it, money that ultimately indirectly went from Fed financing through the CARES Act, came out in the form of $1,200 stimulus checks and $600 a week increases in unemployment benefits, and much of that got spent, consumption. But we would argue that most of the $3 trillion that the Fed created went into other assets rather than being spent. Those assets include stocks, which will push their price higher than would have otherwise been the case. Now, people ask, well, if the Fed is buying bonds, why are stocks going up in price? And, a simple example would be that if the Fed had, instead of deciding to buy $1 trillion worth of bonds, had decided, let's say, to buy $10 billion worth of white wine, it would have certainly driven up the price of white wine. And a lot of people might have switched to red wine. And the effect of that would be to push up the price of red wine too. So by the laws of substitution, if you push up the price of one financial asset, odds are you're going to push up the price of alternative financial assets, including stocks and also real estate, I would argue. A second part of the federal intervention was the CARES Act. $3 trillion borrowed by the Treasury, much of it funded by the Fed's money creation. And while much of that was spent, a lot of it directly or indirectly ended up supporting asset prices. Corporate bailouts, the PPP, payroll protection, or paycheck protection program, much of that money ended up back in markets, stocks and bonds. A third factor supporting the markets is lower interest rates in general. In addition to pushing down bond yields when the Fed intervened in the bond market, the Fed has also set short-term interest rates close to zero. The start of the year, the 3-month Treasury bill was paying about 1.6%. Now it's paying about 0.1%. And when cash pays zero, other things being equal, people are willing to pay more for any asset that reliably throws off positive cash flow. That would include the stock of a company with steady earnings. It would include an apartment building with steady rents. Um, a fourth factor that could explain the seeming disconnect between the market and the economy is just thinking about how markets place a value on stocks, or at least how the textbook tells us they should, which is to say that they look at a long stream, a future stream into perpetuity of earnings from that business. If you think that the downturn that we're having will be not too long-lived, then it's fair to say that, because the majority of the value of a stock is in the out years, in other words, it's not year one, but it's year 2 through N. If you think that you're going to have a relatively short-lived downturn, then you can make the argument that you shouldn't overweight the impact of that on the value of a stock where that value represents all of its future earnings into perpetuity. Finally, something that's been getting a lot of headlines lately is what we'll call a retail investor mania. And this has come about in the most improbable of ways. Last fall, Schwab and Fidelity and others eliminated commissions on trading of most securities, joining a small online broker named Robinhood that had already offered free trading for quite a while. And not surprisingly, the result was a large increase in the number of new accounts and the volume of trading. What is a bit surprising is that trend accelerated as the COVID crisis set in, with millions of new accounts and massive incremental transaction volumes. Many people theorize that in the absence of sports, huge numbers of sports bettors have migrated to the market for entertainment. Many have been drawn in by the rebound in the market that began in late March, and perhaps they've accentuated the run-up. I've seen remarkable statistics about how many young men between the ages of, I think, 20 and 40 regularly engage in sports betting. And in the absence of sports, the market is perhaps the newest casino. I think there's also a sense that the Fed's intervention in the markets has created what economists would call moral hazard. And that's the idea that one can ignore the risks of a bad decision if you assume that the government will step in and essentially bail you out should things go badly. And I think the Fed's intervention in the markets have given a lot of people, I think, a false sense of confidence that markets can't fall. Some of the trading, though, really seems completely divorced from reality. Not unlike what we saw in 1999 at the height of the dot-com mania, seemingly based entirely on short-term momentum. And I'm just going to give you 3 quick examples. One is Chesapeake Energy, a company that's been flirting with bankruptcy for the better part of a year now, was up 182% last Monday, down 66% the next day, the Tuesday, and down another 29% on Wednesday. These are completely mind-boggling fluctuations. Hertz Rent-A-Car, which already now is in bankruptcy, was up 115% that same Monday after having put itself into bankruptcy. It was down 24% the following Tuesday, 40% on Wednesday, and subsequent to that issued $1 billion in new stock under a prospectus which said this stock you should assume is essentially worthless because we're in bankruptcy and stockholders are going to be wiped out. But it's not just these little, bankruptcy situations. Take a large cap company like Boeing, the aircraft manufacturer. Beginning on June 3rd, in a span of 8 days, in the first 5 days, the stock was up more than 50%, and it was down 30% in the next 3. So it's pretty wild out there. And that leads me to, I guess, my concluding thoughts on all of this right now. Today's crazy and, I would say, counterintuitive markets are Exhibit A on why it's so important to establish and stick to a long-term investment plan, because it's that plan that gives you a compass in the middle of a blinding storm. I think today's markets also demonstrate once again the hazards of market timing. Emotions are running high on many fronts. And again, we counsel, don't let your emotions derail your long-term plans. There's a metaphor about radios that I find helpful in thinking about markets, something called the signal to noise ratio. So if you imagine you're driving in your car listening to a Beatles tune on your favorite radio station, and when you're close to the radio transmitter, signal is very strong. There's no noise at all. You hear every word, you hear every strum of the guitar, and so we would say the signal is strong, the noise is non-existent, so the ratio of signal to noise is very high. But as you drive far enough away from the transmitter, you get lots of noise in the form of static, and the song itself gets faint. And so the signal to noise ratio gets low. Right now, I'd say the signal to noise ratio in the investment markets is unusually low. There's a tremendous amount of noise. It makes it very hard to distinguish the signal. But just as the Beatles song hasn't changed, the noise didn't change the song. The only thing that changed was our ability to hear the song. In the stock and bond markets, the song remains the same. We view stock and bond markets as among the surest ways we know to grow one's capital over time. So try to keep that in mind amidst all of the noise that we're having to deal with today. Finally, we said in March, and we'll say it again, this too shall pass. It may pass quicker than any of us expect, or it may drag on much longer than any of us hope, but it will pass. I remind everybody who wants to hear it that we're a resilient bunch. We're all more resilient than we give ourselves credit for. What began in late winter is now approaching summer, and here we are. We're honored to share this journey with you, and I think the best investment advice I can give is has nothing to do with investments, but stay healthy and stay sane. Those will pay greater dividends than any stock. And with that, I will look forward to taking some questions.
All right, fantastic. Well, thank you, Don, for those comments. We're going to now turn to the Q&A portion of our call. So just a reminder, if you want to submit a question for Don to answer, you can use the little Q&A button, which you should find at the bottom of your screen. We're going to start off the Q&A with some questions that were emailed into us in advance. And Don, we've got a few questions, some that are what I'll call market related, some that are more personal finance. Do you have a preference where we start?
Nope.
All right, well, since we were talking a little bit about the markets at the end there, why don't we start there? So the first question says, technology and growth stocks continue to lead the charge as they have for many years now. Do you think value investing is dead? And how do we take advantage of the market surge in tech companies?
Well, I guess the short answer is no. I don't think value investing is dead, but it is going through a long dry spell in relative terms. That is to say that while value investing has done pretty well, frankly, over the last 10 years compared to growth stocks, not so well. Value stocks will eventually have their day. Like any strategy that approaches some subset of the market as a whole, it can be in favor or out of favor for a very long time. But I think the bigger story or lesson to take from this is, I think this is another example of why broad index funds are such a good idea. When you buy the whole market you're not making a bet on whether growth will be better in the near future, whether value will be better, or any other way you want to slice and dice the market. You're buying growth and value. And it's really the only way to be sure that you're going to get exposure to the market's biggest winners. Everybody, of course, focuses on the big winners right now, right? The FANG stocks, Facebook, Apple, Amazon, Netflix, Google, and so on. But nobody knows what stocks are the FANG stocks of tomorrow. But the one thing we do know is that the index funds will own them. So I think that's maybe a more constructive way to think about the problem than trying to guess whether value stocks are about to have their moment in the sun.
All right, great. Moving over to some personal finance type questions. We have a question from a client here. It says, my employer has stopped the matching contributions to my employer-sponsored retirement plan. Should I stop putting money in until they start matching again?
The answer is no. You should keep investing in the plan for a couple reasons. The first thing I would say is that if you're driving from point A to point B and you've been averaging 40 miles an hour, and suddenly you encounter an uphill grade or a headwind or whatever you want to call it, and you're only going 30 miles an hour, it's not a reason to pull off the road. It's more a reason to adjust your expectations, perhaps, as to how much you're going to accumulate, how quickly. So number one, keep contributing. Number two, you're still getting tax deferral benefit when you contribute to a company qualified plan, which means that you're taking pre-tax earnings and you're putting those into the company retirement plan. They're not getting taxed before they're getting invested. They get taxed when you take them out at a later date. But that tax deferral means that you have a larger amount of money growing on a pre-tax basis. And so there's a time value of money to being able to put off the taxes. The only exception to this is if for some reason you felt you were going to be in a much higher tax bracket in retirement than while working, which is unusual, but not impossible. Then there could be an argument for saving the money in an after-tax investment rather than in your company retirement plan. But when the company does start matching again, it's almost 100% the right thing to do is to take advantage of that match, because it's often the equivalent of a 50 to 100% immediate return on your investment.
Great. All right, next question is also a personal finance question. It says, I've read this may be a particularly good year to do a Roth conversion. How does that work, and why might this year present a unique opportunity to convert some money to a Roth IRA?
Okay, so let's first talk about what's the difference between a regular IRA and a Roth IRA. A regular IRA is similar to the company retirement plan we just talked about. It's funded with pre-tax money. It grows on a tax-deferred basis. And at some point in the future, certainly at least when you get into your 70s, you have to start taking the money out of the IRA, and you have to pay taxes on what you take out as you take it out. A Roth IRA, you put after-tax money in, and it also grows tax-free over time, but when you take the money out, you don't pay any taxes on the withdrawals. A Roth conversion is when you take money from a conventional or a traditional pre-tax IRA and you move it into a Roth IRA. And when you do that, any money you move out of the traditional IRA into the Roth IRA, any money you convert, is considered taxable income to you in the year that you take it. So you have to pay taxes on it. If you are at or above the age 70 and a half, and you're taking annual required minimum distributions from a traditional pre-tax IRA, the recently passed CARES Act allows you to skip your required minimum distribution, your RMD, in 2020. And this could put you in a lower tax bracket, which is why 2020 might be a uniquely good year to consider a Roth conversion. But in order for it to make sense, there's two things that have to be true. Number one, you need to have enough money in non-retirement after-tax assets to live on in the absence of taking your RMD from the IRA. And number two, the RMD probably needs to represent most of your taxable income. If you have a lot of income from other sources, skipping the RMD in 2020 might not have much effect on your tax bracket, in which case the Roth conversion might not be so attractive. If this is something that might apply to you, please feel free to contact us and we'll be happy to help you analyze the decision.
Great. Next question, Don. We actually have a few questions that have come in regarding inflation concerns. So, people are asking with the Fed creating, so much liquidity and pumping so much money into the market, do we think there's a risk of a severe inflation spike at some point?
Yeah, that's a great question. What the Fed is most worried about right now is deflation, because an economic contraction reduces purchasing power and runs the risk that prices actually fall. And when prices start falling, as we've seen in places like Japan, you can find yourself in a situation where it's really hard to stimulate the economy. But the question, nonetheless, is a smart one, because it asks, what happens to this 3 trillion or more that has been created out of thin air? Now, as I mentioned earlier, there's a lot of places that money can go. If it goes into consumption, then arguably it could be inflationary. But in the short run, it's not likely to be, because it is simply replacing consumption that would have been lost by virtue of unemployment and loss of income. It can go into assets and cause a different kind of inflation, which I think was one of the points I was making in terms of why the market might have disconnected from the economy. When the Fed pours $3 trillion out there and the great bulk of it ends up in financial markets, you get a different kind of inflation. You get an inflation in asset prices. But of course, assets are simply deferred consumption. At some point, assets, that's really the whole point we save, right? Is so that at some point we can liquidate and use the accumulated value of the asset to consume in retirement or whatever. So I think there is an inflation risk, but it's just so hard, really, really hard to measure. In a perfect world, the economy comes back and the Fed withdraws money from the system, thereby kind of offsetting the potential inflationary pressures that their actions today might later trigger.
Kind of following up on that, Don, one of the questions was, is there anything, we can do in portfolios to help mitigate the risk to a portfolio of a spike of inflation?
Yeah, absolutely. Stocks actually have been one of the best inflation hedges anywhere. And that's in part because companies have the ability to raise their prices and thereby preserve their profit margins when prices generally are rising. Things that are most exposed to inflation risk would be a long-term fixed rate asset like a 30-year treasury bond. They're only yielding currently about 1.5%. If inflation spikes somewhere in the next 30 years, that's something that's going to go way down in price because market interest rates will go up, and that pushes down the price of existing bonds. So, another way to protect at least against being too vulnerable to a spike in inflation is to keep your fixed income assets of shorter duration. And we generally do that. We tend to keep all of our fixed income portfolios below market benchmarks for duration. There are assets that explicitly hedge against inflation, and we do have exposure in most of our portfolios to inflation indexed bonds. These are bonds where the interest rate goes up with inflation. It also goes down with inflation. There are assets like gold, which, in the long run do seem to preserve purchasing power, but their correlation with inflation over the short run is highly unpredictable. So there's a few ideas.
Great. We've got a few questions that have come in about mortgages. Someone's asked, do you think it's a good time to refinance a mortgage? I heard rates are near all-time lows, or would it be better to wait and see if rates go lower?
Well, Scott, why don't you take that one? I'm going to have a drink of water.
Sure. I actually just refinanced my mortgage, so that's a good one for me to field. Yes, I think it is, generally speaking, a good time to refinance, assuming you can meaningfully lower the interest rate on your mortgage. So when I say meaningfully, generally speaking, I think in terms of maybe 0.5% rate reduction. If you're just looking at 1/8 of a point or 1/4 of a point, I might hold off and see if rates go a little bit lower, and you can kind of lock in a more meaningful decrease in your rate. Yeah, standard 30-year rates right now are near all-time lows. They're right around 3% on a 30-year mortgage. 15-year mortgages are around 2.5%, which are really phenomenal levels for mortgage rates. They could certainly go lower. Certainly if you look at, what interest rates have done since the start of the pandemic, general interest rates have decreased more than mortgage rates have. So some people think there may be room for mortgage rates to go lower, and I've heard of some mortgage companies talking about, potentially rates the 2.5% level. Obviously, though, just like markets, no one really knows where rates are going to go. And so I would say, yeah, if you can lock in some savings now at these historically low levels, I would do so. One thing you can do if you want to try and take advantage of rates going even lower, there are things like no-cost refis, whereby you pay a little bit higher interest rate, so that you get a credit from the lender to cover a lot of the sort of, standard closing costs of a refinanced mortgage. Typically those, can range anywhere to 2 to 3% or more of the value of the loan. And so, if rates are at 3%, you might be able to get a rate of 3.125% with a no-cost refi. And then that allows you, if rates go lower, say in 6 months, it allows you to quickly refinance again if rates drop further. So that's one strategy you can use if you're worried about it. Certainly, I don't refi and pay significant points or closing costs and then do it again very quickly. Typically, that doesn't make much financial sense. But if you can take advantage of a no-cost refi, that can be a way to refi again when rates drop. Don, the next question we have related to mortgages, and I think we only got about 1 minute left, so this will probably be our last question of the day, is do we have any thoughts about first-time home buyers using low interest rates to buy a home at this time?
Well, I recall that the mortgage rate I had on my first home purchase was 13.25%. That was 30-year fixed in the mid-1980s. So if you can get 3% now, I think that's pretty good. Now, there's of course the question, well, is this a good time to buy a home? Are home prices going to go down? That's just not clear. You would, on the one hand, expect weakness in real estate prices because so many people are out of work. On the other hand, I'm told that the supply of homes available for purchase has also gone down. And so those two things may have offset one another. but I think I would look at a home purchase much the way one looks at a stock purchase. You can't worry too much about whether you're getting in at exactly the right level. You're buying it as a place to live. You're hopefully going to be a homeowner for a long time. And the exact moment of entry into the home ownership market, I don't think should be driven by concerns about whether you're timing it just right.
All right. Well, I think that's it for our time. We appreciate everybody who joined us today on the webinar. We will be sending out a link to the replay in case you want to share it with family, friends, colleagues. Yeah, we invite you to forward that email on. Don, I think we plan to continue to do these on at least a quarterly basis. So we hope you guys will join us in the future for additional webinars. Thanks so much.
Thank you.
See you next time.